Hello everybody, this is Opayemi. Welcome to my Forex trading course, lesson 2. Now, you can remember in the last lesson, in the lesson 1, we talk about what is Forex trading, what Forex is. We said Forex is foreign, means foreign exchange. We talk about the currencies traded in Forex. We talk about the major currencies traded in Forex and so on. So if you have not watched the last videos, you can go ahead and search for it and watch it on Forex trading course. And please, if you have not subscribed to my channel, please hit the like button and subscribe. Then click the notification button so that whenever I post another video, you'll be able to get the notification. So you are welcome once again. Now, these are the following outlines. These are the outlines we are taking today. Number 1, market size and liquidity. Number 2, dollar. The dollar is the king in the Forex market. Number 3, different ways to trade Forex. Number 4, advantages of trading Forex. Number 5, Forex versus stock. And the last one, Forex market players. Now let's start. Market size and liquidity. Market size and liquidity. The Forex market is spread all over the globe with no central location. The Forex market is all over the world. There is no particular location. There is no central location. If you want to trade Forex, you can trade Forex anywhere you are, any country you are. Nigeria, USA, Germany, anywhere you are, you can trade Forex. Why? Because it has no central location. It takes place anywhere. The Forex market is the biggest and most popular financial market in the world, traded by a large number of individuals and organizations. It is the largest market in the world. That's why it can never go down. If your country says they ban Forex, other countries will trade Forex. That is Forex trading for you. It is very large. It is the largest, and it has no central location. You can trade it anywhere you are, any country you are. Now, the next outline. The dollar is the king in the Forex market. If you can remember in the last class, when we talk about the major currencies, you can see that the major currencies, the number 1 there was the US dollars. The US dollars. And if you also remember, when we talk about the major currency pairs, we talk about the major currencies, we talk about the major currency pairs. The major currency pairs, if you can remember, all of them have the US dollars. Why? Because the dollar is the king in the Forex market. Why is the dollar the king in the Forex market? Because the dollar is the strongest. It is everybody wants to own the dollar. According to the International Monetary Fund, the US dollar comprises roughly 62% of the world's official foreign exchange reserves, because almost every investor, business, central bank own it. They pay attention to the US dollar. For example, if you want to buy oil, you will not use your currency. You will have to convert your currency to US dollars in order to get it. So That's why the US dollar is the king in the forex market. Now, let me show you this. This was this data was conducted in 2012. Let me show you. Can you see? Can you see the chart? Can you see this chart? Can you see this graph? The US dollar has 84%, 84.9%. Second is the euro, Japanese yen, Great Britain pound, Australian dollar, Swiss franc, Canadian dollars, while other currencies take up the remaining 25.0%. The others take 25.0%. Can you see? The major currency, US dollar, euro, Japanese yen, Great Britain pound, Australian dollar, Swiss franc, Canadian dollars, they took their share. Then the others, there are a lot of currencies all over the world. They make up this 25%. Now let me show you the one that was taken in 2020. See, you can see claims in US dollars 6,770.51 US dollars, the highest. Second is the euro. You see, the third, the Chinese. Chinese is coming up. Their economy has improved tremendously. They are coming up too. So let's continue. Now, there are also other significant reasons why the US dollar plays a central role in the forex market. Number one, the United States economy is the largest economy in the world. Two, the US dollar is the reserve currency of the world. Three, the United States has the largest and most liquid financial market in the world. Four, the United States has a super stable political system. Five, the United States is the world's sole military superpower. When it comes to military power, we give it to the United States. They are the superpower. They are the strongest when it comes to the military. Then, six, the US dollar is a medium of exchange for many cross-border transactions. For example, oil is priced in US dollars. So if Mexico wants to buy oil from Saudi Arabia, it can only be bought with US dollars. That is it. So Mexico will have to convert their currency. They will convert their currency to the US dollars before they can purchase the oil from Saudi Arabia. They are not buying from USA. They are buying from Saudi Arabia. But because they have to use the US dollars, even though they are buying from Saudi Arabia. Now, different ways to trade forex. What are the different ways to trade forex? Number one, spot market. In the spot market, currencies are traded immediately. That's why they call it spot. Spot, immediate. Currencies are traded immediately or on the spot using the current market price. What's also about this market is its simplicity, liquidity, tight spread, and round-the-clock operation. They are traded for immediate delivery. It's immediate. That's why it's called spot. The second way in which we can trade forex is the futures. Futures are contracts to buy or sell a certain asset at a specified price on a future date. Future. This one is not immediate. It is in the future. That's why they call it futures. The third ways in which you can trade forex is the options. An option is a financial instrument that gives the buyer the right or the option, but not the obligation to buy or sell an asset at a specified price on the option's expiration date. Now, look at this one, expiration date. It expires. Once it has expired, that's it. The transaction is completed. That's it, the difference. This one, it has expiration date. If you have traded binary option before, you see that in binary option we have expiration date, expiration time. It could be 1 minute depending on the time you choose. But the one I did before, the highest time was 15 minutes. So you can choose 1 minute and choose 2 minutes, any one time you like. But the highest was 15 minutes. And once it's 15 minutes, if you are in profit, you win. If you are in loss, you lose. You lose your money. And the fourth one is the exchange traded fund. Exchange traded fund. That's the ETFs. I also trade forex using the exchange traded fund. Exchange traded funds, or ETFs, are the youngest members of the forex world. An ETF could contain a set of stocks combined with some currencies, allowing the trader to diversify and deal with different assets. These are created by financial institutions and can be traded like stocks through an exchange. Like forex option, the limitation in trading ETFs is that market isn't open 24 hours. Also, since ETFs contain stocks, these are subject to trading commissions and other transaction costs, since it contains stock. Now, advantages of trading forex. What are the advantages of trading forex? Number one, no commission, no clearing fees, no exchange fees, no government fees, no brokerage fees. Most retail brokers are compensated for their services through something called bid-ask spread. As we go on, we will talk about spread. You know, I mentioned it in the last class. It's what we call spread. That's where they charge their cost. No middleman. There is no middleman. Another advantage of trading forex, no middleman. Spot currency trading eliminates the middlemen and allows you to trade directly with the market responsible for the pricing on a particular currency pair. There is no middleman. Unlike when you are trading in stock, you have to get an agent. But in forex trading, there is no middleman. You trade directly. You trade directly. So no fixed lot. In the futures market, lots or contract size are determined by the exchanges. A standard size contract for silver futures is 5,000 ounces. In spot forex, you determine your own lot or position size. So you choose the lot you want to use. You choose the lot size you want to use, whether it's a standard lot or just choose. You can use lot, you can use 1, you can use 0.1, you can use 0.5, you can use 0.01. It depends on you, and it depends on how much you want to risk. The next one is low transaction cost. Low transaction cost. The retail transaction cost, that's the bid ask spread, is typically less than 0.1% under normal market conditions. Under normal market conditions. At larger dealers, the spread could be as low as 0.07%. This also depends on the broker you are using. Depends on the broker you are using. The fifth one, a 24-hour market. Forex is a 24-hour market. There is no waiting for the opening bell from Monday morning. From the Monday morning opening in Australia to the afternoon close in New York. The forex market never sleeps. It opens on Sunday evening, but in my country it's Sunday evening, around 10, 11. But in Australia it's Monday morning. So it opens on Monday and closes on Friday. 24 hours, 5 days. So there is no waiting for the opening bell. From the Monday morning opening in Australia to the afternoon close in New York, the forex market never sleeps. This is awesome for those who want to trade on a part-time basis, because you can choose when you want to trade: morning, noon, night, during breakfast, or in your sleep. You can choose when you want to trade. No one can corner the market. The foreign exchange market is so huge and has so many participants that no single entity can control the market price for an extended period of time, because it's so huge. And leverage. In forex trading, a small deposit can control a much larger total contract value. Leverages gives the trader the ability to make nice profits and at the same time keep risk capital to a minimum. In high liquidity, because the forex market is so enormous, it is also extremely liquid. This is an advantage because it means that under normal market conditions, With a click of a mouse, you can instantaneously buy and sell as well as there will usually be someone in the market willing to take the other side of your trade. For example, if you click buy, there's someone there who is willing to buy. Once you click buy, there's someone on the other side who will sell to you. You know, when you want to buy, somebody must sell. So that's, that you have to wait for somebody. Once you click buy, when it's time for you to complete the transaction, you close it. You make profit or loss. Low barriers to entry. You will think that getting started as a currency trader will cost a ton of money. The fact is, when compared to trading stocks, options, or futures, it doesn't. Online forex brokers offer mini and micro trading accounts, some with a minimum account deposit of $25. Some even offer lower than $25. I've seen a broker that offers $10. You can trade with $10. I've seen another broker that offers $1. You can trade with as low as $1. Some even offer cent accounts. You open a cent account. The cent account will look like dollars account, but it's a cent account. And you can open with as low as $15 with them. So you don't need too much money to start. Now, forex versus stock. The largest difference between the forex and the stock market is, of course, what you are trading. That's the largest difference. What are you trading? Forex is a marketplace for the buying and selling of currencies, while the stock market deals in shares. And what is shares? Unit of ownership in a company. That's the largest difference between the forex and stock. Of course, there are some other differences which we have even mentioned before. Advantages. Now, forex market players. Who are the forex market players? Number one, the super banks. The super banks. Since the forex spot market is decentralized, it is the largest banks in the world that determine the exchange rate. Based on the supply and demand for currencies, they are generally the ones that make the big ask spread. They take huge transactions for both themselves and their customers. A couple of these super banks include UBS, Barclays Capital, Deutsche Bank, and Citigroup. You could say that the interbank market is the foreign exchange market. These banks, they are the ones that move the market because their volume is so huge. I know the price is determined by forces of demand and supply. So because of the large volume they have, once they get into the market must move in their direction. So what do? We just have to move with them. How do we move with them? That's why we are doing this course. Because if you move against them, you lose because they have large volume. They are huge. They are big. So those are the super banks. Number two, the large commercial companies. Companies take part in the foreign exchange market for the purpose of doing business. For instance, Apple must first exchange its US dollars for the Japanese yen when purchasing electronic parts from Japan for their products. Since the volume they trade is much smaller than those in the interbank market, this type of market player typically deals with commercial banks for their transactions. Mergers and acquisitions between large companies can also create currency exchange rate fluctuations. In international cross borders, a lot of currency conversation happens that could move prices around. So, they are large commercial companies. Then the government and central banks. The government too are also players in the forex trading market. Government and central banks such as the European Central Bank, the Bank of England, and the Federal Reserve are regularly involved in the forex market too. Just like companies, national governments participate in the forex market for their operations, international trading payments, and handling their foreign exchange reserves. So government and central banks they are also involved in forex market. Meanwhile, central banks affect the forex market when they adjust interest rates to control inflation. By doing this, they can affect currency valuations. Yes. As we progress, we will talk about news in the market. In the market, once there is a news, the market moves. The news may be as a result of the central banks. So, by doing this, they can affect currency valuations. There are also instances when central banks intervene either directly or verbally in the forex market when they want to realign exchange rates. Sometimes central banks think that their currency is priced too high or too low, so they start massive sell or buy operations to alter exchange rates. The speculators, they trade forex to make profit. Now, the speculators, they trade forex to make profit, comprising close to 90% of all trading volume. Speculators, as forex market players, come in all shapes and sizes. Some have fat pockets, some roll thin, but all of them engage in the forex simply to make bulk loads of cash. So these speculators, they are in the market to make profit. They are trading. They want to make money. So their own goal is to make profit. So that's why they speculate. And please, once again, like and subscribe to my channel and click the notification button so that when I post another video, you'll be able to get the notification. This is the end of the lesson 2. So in lesson 3, we shall continue. So, bye-bye.